Welcome to Larson U. I'm Allison Johnson. Today in Statutory, we're going to be talking about property and casualty risk-based capital, or RBC as we'll be referring to it today. Here's an itinerary for our training today. We're going to start with some background on RBC and how it came to be, go through some introductory terms just to familiarize ourselves with the terminology. Then we'll go dive into the formula. This is where we're going to come and look at all the different pieces to our puzzle, and we'll put them all together with the risk elements as we find out how those impact the RBC calculation. Then we'll go into the actual calculation and see how those puzzle pieces finally fit together to come up with your RBC number. The last thing we'll talk about is ratios and compliance and how that RBC number impacts your compliance with the regulatory standards. So some background on RBC. RBC didn't come around until the 1990s. So before that, any surplus requirement was really just a baseline of the surplus required to start an insurance company. There wasn't anything to maintain an insurance company and what you required. So that surplus wasn't really a good measurement of risk. In addition, that requirement could vary by state, and it didn't account for the financial risk or profile of the actual insurance company. So like I mentioned, in the 1990s, the NAIC created a committee to start looking at this and to create a formula. And that finally was implemented in the late 90s. Some key components of this formula and what they were hoping to achieve was coming up with a calculation for capital adequacy that related to risk. It was also meant to create a safety net for the insurer. So RBC is a good guide as to help see when you might be starting to be in trouble. Similarly, that also provided regulators both a metric to gauge when an insurer might be in surplus trouble. It also provided them the authority to step in once RBC gets to a certain level. The other benefit of this is that it's uniform across the states. So it's comparable when you're looking at insurers that are domiciled in different states. So an introduction to this formula. Some of the key concepts you're going to want to be thinking about as we talk today is, and to be aware of, is the RBC formula is unique by carrier. So today we're talking about property and casualty, and while some of the concepts are similar, there will be different risk charges between the life, health, and property and casualty carriers. Remember, this is also an elastic measurement. This is something that as the company changes and grows, or their investment portfolio changes, the RBC formula, the formula is the same, but the results will be different. It also produces different capital requirements for different companies, which makes sense, right? Different companies have different underwriting risk, they have different markets and different target insureds, they have different investment portfolios. So while the formula is the same, we wouldn't expect any two insurance carriers to have the exact same, RBC inputs and formulas. Then the last thing, just to have as a frame of reference as we're talking through things, is what the RBC ratio looks like. So the numerator in that calculation will take into account what your actual surplus is as a carrier, and then it will compare that to the required surplus from RBC calculation. So we're going to circle back to this formula at the very end once we've talked through all of the inputs. To kind of highlight why RBC is important, I wanted to stop and look at this example. So we have two companies listed here that if we just look at the total capital and surplus line, would suggest that they both have the same capital and that that's the same quality of capital, I guess I would say. But if we look upwards towards the assets and liability section, we'll see that they're actually not that comparable. The assets of company A are lower quality bonds, and the other investments are in lower quality investments, whereas company B is in investment grade bonds and higher quality stocks, loans, and real estate. Even on the liability side, you can also see that the underwriting risk is pretty different. Company A is insuring workers' comp for construction companies and Florida homeowners, both higher risk industries, whereas Company B is insuring good drivers and homeowners in Idaho, so maybe less risky industries. So this just highlights why RBC matters. It helps us come up with another metric to truly know what RBC is sufficient for a company based on their risk. So let's highlight the formula. So most aspects are factor-based. So you'll see that we have, an investment base, there's an underwriting base, and then there's factors applied to that. And that's how we're going to come up with ultimately the required risk-based capital. Note that factors don't vary by company, but there are some of the factors that are impacted by volume and concentration. So the volume applying to your business, the volume of premium, and the asset concentration is your investment. So when they were creating this RBC formula, they ran all these factors through different scenarios. And the factors that you'll see and we'll talk through were the ones that came up with the best results 95% of the time. And in this case, the best results meant that there was sufficient capital to handle any kind of financial crisis. As we go through this, you'll note that you see R0 or R1 as we're talking through the different risks. That R just stands for risk. I didn't want it to be confusing. And so just know that you don't have to worry too much about that piece. There are a few things that this formula can't account for that we can't necessarily quantify, but that should be considered when you're thinking about the risk of a company. So these are things like management's experience and integrity, company's adaptability. If the market changes or there is a catastrophe, how quickly can they respond and address that in their business model? How quickly can they, what kind of access do they have to capital markets? Both how quickly can they get them and the quality, the adequacy of premium reserves, their future business plans, as well as policy and shareholder confidence. So remember, while RBC is useful, it's not the only thing we should be considering. As we're going through, you'll also note that in the factors, as we're talking through them, higher risk items result in a higher factor and therefore higher amounts of required capital. So we're going to jump into the actual pieces of the formula. So we call these risk elements. So we have, you'll see quite a few we're going to work through today. And these are the puzzle pieces that come together to form the RBC formula. So we're going to start with affiliated assets and off-balance sheet risk. So for affiliated assets, it's calculated on what we call a look-through or a see-through basis. You have to look all the way down to the lowest level of ownership to see what this qualifies. So affiliated investments typically fall into two categories. You have those that are insurance subsidiaries or investment subsidiaries that may already be subject to their own RBC calculation. And you also then, the other category would be subsidiaries that aren't subject to their own RBC calculation. Note that there are publicly traded insurance companies have aspects of both in them, but we'll talk through examples of how these are impacted and what the RBC charges. So for affiliates that are subject to their own RBC calculation, it's easy, which is great. So you're going to take that subsidiary's RBC calculation, and that becomes the RBC requirement for that asset. Some examples of affiliates that aren't subject to RBC calculation would be holding companies, upstream investments, potentially some of your investment affiliates, as well as other affiliated investments. For off-balance sheet risk, there's a factor of 1%, and things that would fall under this category would be things, amounts you're holding or you have pledged as collateral, non-controlling interest in or non-controlled assets, guarantees that you might be liable for, as well as contingent liabilities. So we're going to move into some of the asset risks. So the first one we're going to look at is fixed income. So note that this represents over 60% of the P&C industry's total assets. So this is one of the largest factors we're going to look at on the asset side. So as a reminder, the NAIC ratings, NAIC 1 is the highest quality with NAIC 6 being the lowest. The RBC charges directly relate to this. So we wanted to just refresh on what these were and which S&P ratings fall into which category loosely. Note that NAIC 1 or 2 is what's considered investment grade fixed income. So the factors for the bonds, you can see here, government bonds being the least risky have a 0% RBC factor, all the way down to NAIC 6, which has a 30% factor. And then they range in between. And just as a reminder, when you're doing this calculation, the RBC factor is applied to the book adjusted carrying value of the investment. Note that there are some other pieces that impact the RBC charge. So depending on the diversification of your bond portfolio, there may be an additional charge. Generally, the idea, as you can see here, is that fewer issuers equals more risk, and therefore it requires some additional capital, whereas more issuers, you're more diversified, you have less risk and less capital is required. So this pushes insurers to diversify their portfolio. So here's an example of how that would work. So if you have a portfolio with limited issuers, that RBC charge could increase by 2.5 times. If you have 50 issuers, it's a factor of 1.5, and a portfolio of 200 issuers or more has a factor of 0.45. So this is less of an issue about the quality of the issuer. It's not accounting for that. That's kind of already accounted for in the NAIC ratings. This is more just looking at overall diversification and adding that factor on. So the next asset risk we're going to look at is equity. So we'll start with this one in preferred stocks and common stocks. So preferred stocks are going to behave very similar to the bonds. They should have an NAIC designation and they'll fall into that same RBC factor as the bonds did based on their NAIC designation. Common stocks don't have an NAIC designation, so this is just a flat factor of 15% that you'll apply to your equities. Here's a listing of some of the other factors for things like mortgage loans, short-term investments, Schedule BA assets, real estate, and other aggregate write-ins. So we don't have a more specific example, but wanted to make sure these were available. And this clarifies a little bit more for ownership in affiliated investments. We've talked earlier about if it's an affiliate with RBC that pulls through. This clarifies a little bit if an affiliated investment is not an insurance company, then the RBC charge is you take the carrying value of the investment and the RBC charge will land somewhere between 22.5% and 50%. But there's a lot more that goes into that calculation and that's outside the scope of this training. We're trying to keep this pretty high level. So just know that if you have affiliated investments that are not insurance carriers, that you need to do a little bit more looking into the RBC calculation on those. There is also a concentration RBC charge for equities. So it requires you to look at your top 10 exposures. So the largest 10 holdings you have essentially, and then the RBC factor on those will double. There is a cap that it can't be more than 30% RBC charge, which if you remember the initial charge on equities is 15%, so it shouldn't exceed 30, but you would apply that to your 10 largest. Note there are some items that are exempt from looking at your 10 largest exposures, US government bonds, affiliated stocks, some mutual funds, property, and then a few other things. So be aware that when you're trying to determine your top 10, make sure you're excluding the appropriate items. The next risk we're going to talk about is asset risk relating to credit. So this is the risk that your assets will default. There might be significant fair value fluctuations, or think about like receivables that there might be some risk that you're not going to get back or receive the full amount. So as we know, the risk of loss due to debt or non-payment, the biggest things that would be impacted by this would be reinsurance recoverables, as well as if you have any other receivables or assets. So we'll talk about reinsurance recoverables first. So this includes recoverables on both paid and unpaid losses. The RBC charge relates to the reinsurer's financial strength, which makes sense because if they're more financially stable, that reduces your risk. Note that the recoverables are also reduced by any Schedule F penalty. And then there's 120% factor. So there's a couple moving pieces there. And the RBC factor is going to range, right, based on those factors we talked about the reinsurer's financial strength and depending on what your Schedule F looks like. So typically, you'll see that anywhere from 3.6% for the highest rated up all the way up to 14% for lowest rated reinsurers. So that's, again, one of those is going to vary depending on who your reinsurance agreements are with. So this is a framework, hopefully, to help as you're looking at that. A few miscellaneous assets that would also fall into this category, things like guarantee fund receivables, receivables from affiliates, if you have investment income due and accrued, those have their own factors. So you want to make sure you're catching everything that should have a factor applied. Okay, the next two are R4 and R5, and they're similar risks. So we're actually going to lump these together as we talk through them. So this is our underwriting risk, both related to reserves and net premium written that we've abbreviated as NPW throughout the slides. So this is risk related to that you maybe didn't price a product right, or didn't, as you were underwriting, maybe it's not a whole product, but maybe a renewal wasn't priced appropriately so that your premiums weren't sufficient for whatever reason. And this also addresses if your reserves were insufficient. So this is the most significant category in the RBC formula for P&C companies. And we talked about what these risks represent. So what this is trying to get us to is the amount of capital needed to support the risk that you have significant adverse reserve development. So that could also be driven by, maybe your reserves you thought were sufficient, but then actual claims activity comes through and you find out that they weren't, or that premium underwriting, again, maybe you thought you were okay, but once it actually comes through and you realize you're not, that's why this is included in RBC to help address that. So the RBC factors we'll talk about are applied to reserves and premiums by line of business. Note that we'll take those factors, but there are some adjustments to consider. So the first is the adjustment based on the individual company's recent history. So they call this a relativity adjustment. So it could be that maybe as of late, your losses are running really well and you're not having that kind of adverse experience. This provides an opportunity to adjust that NAIC factor. The second factor is based on investment income. So it's a discount adjustment of sorts. So there's some other credits, and that's kind of what we talked about. Loss sensitive credit, as well as the line concentration that would reduce the RBC required. So that's going to be kind of your relativity adjustment we just talked about, as well as based on lines of business. There is something that increases RBC, and that would be an excessive growth penalty. So if you're growing too quickly, that does pose a concern of, do you really have the capital to support that? And so this adjustment to RBC tries to help account for that if you are growing quickly, there's additional required RBC. And then the last is there are some additional health insurance risks. If you happen to write P&C as well as some A&H business, know that there's some considerations for your health insurance piece. Some off-balance sheet underwriting risks. The NAIC has prescribed this 1% factor. This would apply as well to collateral, non-controlling interest, guarantees, and contingent liabilities. The last one we're going to talk about, and this is unique to P&C, is RCAT, which is the catastrophic risk. So this is a newer RBC risk category, and currently they're just measuring catastrophic risk related to earthquakes and hurricanes. And so we don't have an example here because it largely relies on the company's modeling of what they think their exposure is related to catastrophes. And based on that modeling, there's a factor for net catastrophe risk and contingent credit risk. So if those are two lines of business that you're writing, we would encourage you to do a little bit more detail on this specific calculation, but wanted to make you aware that this was a risk and a newer risk factor to be considered. So we've come together with all of our puzzle pieces and we're going to plug them into the calculation now. So as a reminder, it's determined, the purpose of this is to determine or estimate the necessary RBC levels to manage losses. So it could be multiple loss years or a series of catastrophic financial events, whatever may cause that. The thing we do have to remember is that it's not likely that all of those events are going to happen at once. So the formula takes that into account. It adds up all of the risk, and then there's some math involved, and I can't tell you how the math exactly works, or why it works, but we'll look at the actual formula. You can see that each risk is considered, and my apologies, those should be R0, R1 instead of H, but it squares those and then square roots them. So the result is that the amount of RBC you need to avoid regulatory intervention. Note, if you do have a captive insurer, reinsurer, there's some differences here, but those aren't highlighted in our training today. So now that we have the RBC, what's the required RBC for, say for your company, we have a couple other numbers we need to calculate to get that ratio. So the first is that total adjusted capital. So this is the actual capital on your books that you're going to compare to that RBC requirement. So you'll start with your statutory capital and surplus, but there are a couple adjustments we need to make. Those are highlighted in the second bullet point. So non-tabular reserve discounts get adjusted for, investments in life insurance affiliates, and then there's some other minor adjustments. Note that if you have an insurance subsidiary, these adjustments get made at both the subsidiary level and the parent level as you're considering what total adjusted capital should be. So this is our formula, if you remember from the beginning, where total adjusted capital, or the actual capital we have, gets compared to the risk-based capital we just calculated and the required amount. So once you have that number, this chart outlines why it matters. So as you're calculating that, if you're over 100%, then there's no problem. Regulators aren't involved, then you're in great shape. So there's no action required. Note that if you're below 125% and you're trending downward, then a company action level may be triggered. So just be aware of that. If things are trending downward, that even though you aren't officially in the next category, be aware that that may still trigger. So speaking of the next category, which is company action level. So if you're between 75 and 100% of RBC, you're expected to have a plan to correct those deficiencies. And note that that plan is subject to the regulator's review and approval. So this is where regulators start to get a little concerned, and so they want to see how you're going to right the ship. The next level is regulatory action level, which is between 50 and 75%. So similar to before, you still need a plan to correct it, but you can also expect that the examiners are going to be, the regulators are going to be more involved with examinations, and they can dictate corrective orders and potentially require the use of consultants to help get things trending the right direction or to figure out how you're going to fix RBC. The next level is authorized control level, and that's between 35 and 50%. So it's similar from the last one. Everything applies. You need a plan. The regulators are going to be involved with examinations, but at this point, the regulators may decide, things aren't going well. We're going to step in and either liquidate the company or put it into conservatorship, where they're going to now run the company. So that's kind of up to the regulators at that point. It's not until the very last option where RBC is below 35%, which, just to maybe step back and think, that means for every dollar of required surplus, you only have 35 cents. So it's pretty dire straits at that point. And at that point, the regulators have to get involved and either liquidate or take over the company. It's no longer optional. So calculating your RBC correctly and knowing what goes into it to help manage that is important, so you can make sure you're in the no action category and that you have sufficient surplus. And that's the end of our training today. Hopefully that was a good overview of RBC and what goes into it. You noted throughout the training that a lot of these are very client specific to your company. So as you're looking through that or doing additional research, we're happy to help wherever we can. My contact information is on the slide. Feel free to reach out, and we are happy to discuss more. Thank you so much for your time today.